Meta owns just 20% of the $27 billion Hyperion campus, yet its filing says maximum exposure to the venture reached $45.99 billion by March 2026. The two numbers measure different things. Funds managed by Blue Owl own most of the vehicle, bond investors provide part of the debt, and Meta pays rent, with a guarantee beneath it. Here is who fronts the cash, who collects, and where the downside sits. Start with the boundary. $45.99 billion is Meta's maximum exposure to loss, not an expected loss and not the campus debt balance. The filing says it combines 4 layers: Meta's equity carrying value, lease commitments, estimated future funding commitments, and the maximum residual value guarantee threshold. Ownership answers who holds the venture. Exposure asks how much Meta could lose across several contracts under severe assumptions. To see why those answers diverge, we have to rebuild the deal one layer at a time. Pause on that ownership chart. If Meta owns only 1/5, why does its disclosed maximum exposure exceed the entire $27 billion construction estimate? Because equity ownership is only one layer. The lease, future funding, and residual value guarantee sit on different lines. So the real question is not who holds the deed. It is who must pay when the campus is finished, or when demand changes. Meta's October 2025 announcement says funds managed by Blue Owl own 80% of the venture, and Meta retains 20%. Both committed to fund their pro-rata shares of roughly $27 billion in estimated development costs. Blue Owl funds made an initial cash contribution of about $7 billion. Meta contributed land and construction-in-progress assets and received a one-time distribution of about $3 billion. A portion of Blue Owl's capital was to be funded by debt sold to PIMCO and selected bond investors. These are different pools, not one number to add twice. The project vehicle matters because it owns long-lived physical infrastructure. Meta's announcement names the buildings, power, cooling, and connectivity systems at the Louisiana campus. The venture holds the property while Meta provides construction management, administrative services, and property management. The 2026 filing says those service roles do not give Meta the power over the activity that most strongly drives the venture's economic performance: remarketing the campus through future leases or property sales. That accounting conclusion has a practical meaning. Meta does not consolidate the vehicle because it says it is not the primary beneficiary. The campus can therefore sit outside Meta's consolidated property balance in this structure, while Meta still has equity, funding, rent, and guarantee exposure. Think of a warehouse built inside a separate box. Owning 20% of the box does not tell you how large the rental contract is, who financed the walls, or who covers a future drop in the warehouse's value. Those questions live in separate contracts. Now follow the rent. Meta's March 2026 filing says its leases with the venture begin in 2029 and cover the right to use properties across the campus. The aggregate initial lease commitment is about $31 billion. Each property starts with a 4-year lease, and renewal options can extend the total lease period to as long as 20 years. That 4-year opening term provides flexibility, but it is not a 4-year economic story. The owners and lenders are financing assets designed to operate much longer. Rent is the cash flow bridge between Meta's demand for compute capacity and the capital provided by the venture's owners and bond investors. If Meta renews, the campus continues serving its intended tenant. If Meta does not renew, the venture must release or sell specialized infrastructure. That is why residual value becomes central. The rent line measures payment for use. The guarantee line addresses what the property may be worth if that use ends. The guarantee is the layer most likely to be misread. Meta disclosed residual value guarantees with an aggregate threshold of approximately $28 billion, decreasing over time. If Meta terminates or does not renew a lease and other conditions are met, the maximum payment for that property would equal the shortfall between its fair value at that time and the applicable guarantee threshold. That does not mean Meta expects to pay $28 billion. As of March 31, 2026, the filing said payments were not probable and recorded no liability for them. The threshold also declines as the campus ages. Picture a safety line under a future resale price. If the property's fair value remains above the line, there is no shortfall under that mechanism. If it falls below the line after a qualifying non-renewal or termination, the gap may trigger a capped payment. The guarantee shifts part of the residual value risk toward Meta, without making every possible dollar a current obligation. Now the headline can be rebuilt. As of March 31, 2026, Meta reported a $37 billion carrying value for its equity investment in the venture. It also disclosed lease commitments, estimated future funding commitments, and the maximum residual value guarantee threshold. Together, under Meta's maximum loss framework, those layers produced $99 billion of maximum exposure. Do not reverse engineer the total by casually adding rounded headline figures. Some commitments change over time, the guarantee threshold decreases, and the filing supplies the authoritative total for that date. More important, maximum exposure is a boundary estimate. It does not say every component becomes payable at once. It does not say a $99 billion loss is probable. It does not turn the venture into $99 billion of Meta debt. It says legal ownership alone understates the amount of economic exposure Meta has accepted through a bundle of equity, rent, future funding, and contingent support. Zoom out from Hyperion. The Bank for International Settlements describes a broader AI infrastructure pattern. A hyperscaler takes a minority stake, signs long-term leases or capacity agreements, and may provide guarantees, while debt sits at a separate project vehicle. The BIS calls these obligations economically similar to borrowing even when much of the associated debt remains outside the hyperscaler's balance sheet. Its shorthand is shadow borrowing. That phrase is an analytical lens, not Meta's label for this venture. Meta's own announcement gives the specific link. Part of the capital raised by Blue Owl was to be funded through debt issued to PIMCO and selected bond investors. Lease cash flows and asset value matter to those investors. Guarantees can improve perceived protection, but they can also connect the tenant's credit to vehicle-level financing. The BIS warns that refinancing pressure or a pullback in private credit appetite can transmit stress. The structure moves and divides risk. It does not make risk disappear. Test 3 paths. In the first, Meta uses the full campus, renews the leases, and rent supports the vehicle. Meta gets compute capacity without funding every dollar as direct corporate construction. Venture owners and bond investors receive contracted cash flows. In the second, Meta does not renew, but the campus still has strong market value. A new tenant or sale may protect the owners, and the guarantee shortfall may be small or zero. The third path is the stress case. AI demand changes. A specialized campus is hard to remarket, fair value falls, and refinancing becomes more expensive. The venture and its investors face asset and funding pressure. Meta may face a guarantee payment if contractual conditions are met, plus whatever lease and funding commitments still apply. Federal Reserve Governor Lisa Cook noted that companies had announced more than $5 trillion of data center plans by May 2026, with only a small portion realized. Scale makes the residual value question a system question, not just a footnote. Audit any AI infrastructure deal with 6 checks. First, separate ownership percentage from control. A minority investor can have major contracts without directing the vehicle. Second, separate total development cost from cash already raised. $27 billion is an estimate for the campus build, not one day's financing balance. Third, separate rent from debt. Lease payments may support debt, but they are not the same accounting line. Fourth, separate a guarantee threshold from an expected payment. Read the trigger, fair value test, cap, and decline schedule. Fifth, separate maximum exposure from recorded liability. Meta said the residual value payments were not probable and recorded no liability as of the filing date. Sixth, pin every number to a date and source. The 2025 announcement rounded the initial cash and distribution. The March 2026 filing updated carrying values and maximum exposure. If a headline mixes dates, scopes, or categories, rebuild the ledger before accepting its arithmetic. The 20% and the $99 billion can now coexist. 20% describes Meta's membership interest in the venture. $45.99 billion describes the maximum loss exposure Meta disclosed across its investment, leases, future funding, and residual value guarantee as of March 31, 2026. One is a cap table answer. The other is a contract stack answer. The likely benefit is flexibility. Meta can secure a massive AI campus while outside capital finances most of the vehicle. Blue Owl managed funds and bond investors gain access to infrastructure backed by a major tenant. The trade-off is a web of long-duration links among rent, asset value, guarantees, and refinancing. Watch the 2029 lease start, the venture's funding progress, any change in the guarantee threshold, and whether future disclosures revise Meta's maximum exposure. The decisive question is not simply who owns Hyperion. It is who still pays if demand, lease renewal, or campus value changes before the 20-year option horizon ends.